Welcome back to Indianomics. We've been asking the question, is the worst over for the banking sector? Is it that NPLs or bad loans, default loans, will rise at a slowing pace in the days to come? Our good days round the corner. I have with me Shashwata Guha of Fitch Ratings, Shrikant Vadlamani of Moodys, Arun Kumar of Care Ratings, and Mr. Pradeep Kumar, just recently retired Managing Director of State Bank of India. Now, Arun Kumar, lately, Care has come with the maximum number of default ratings. We saw default of what? Lanco, GMR, JP, a whole bunch of assets. What is the thesis from the corporate angle? Are the number of upgrades more than the number of downgrades?
Yeah, for the last 2 years, I mean, we have seen this data, as you will also be having, the upgrade-downgrade ratio. We call it the modified credit ratio. It is upgrades plus reaffirmations divided by downgrades plus reaffirmations. That has been above 1, meaning that the upgrades have been exceeding downgrades. And just to correct a sentence before, it includes even banks. So it includes everything. All ratings are included here.
Okay. So, now, when you say that the number of upgrades are higher than the number of downgrades from second half of FY14, what is the value of assets that are upgraded and value of assets that are downgraded? If you go by the value, will you still say the amount of stress is declining?
See, actually, we have a thing called Care Debt Quality Index, called the CDQI, which we publish every month. So that we have not taken the entire sample because it's not possible to track the entire sample of care rated companies. So we've taken a static pool of some ratings as of March 12. So with respect to March 12, which is 100, indexed at 100, we track month on month what is the value weighted one. Yeah. We have a, for example, for a default rating, it will be 0. For the AAA rating, it will be the highest value.
Yes.
So we ascribe this value, weighted average of this value has been declining.
Okay.
Has been declining.
So the stress is increasing in the system.
I mean, with respect to 12, definitely today is worse off. That's what we are saying in terms of the overall credit quality in the system.
Okay.
And we do expect this to fall in a couple of months more. It's expected to fall, and thereafter we expect the economy to stabilize and recover, and after that it could be.
So you are basically contradicting what the other financial rating agencies are saying. You are expecting further defaults, at least in terms of the amount of money at stake.
Not defaults per se, downgrades, because...
yeah, fair enough. Okay, now let me get the veteran banker in who has seen it all, been there, done that. Mr. Pradeep Kumar, what is your sense? Do you think that the stress is going to be incrementally less? Or do you think you just have to wait for a couple of more quarters before you can make that comment?
I think stress is going to be incrementally less if you see the numbers, at least of State Bank of India, both for Q1 and Q2, which has been published today. For the last 3 years, the quarter-on-quarter decline has come down, which is an indication the stress is coming down, albeit not at the pace at which a banker would like, but yes, it is coming down. It is perhaps an indication that the stress is coming down very slowly. As I think one of them said, incremental NPA formation is going to be slower. Yes, gross NPAs in terms of numbers are bound to increase, but at the incremental pace is going to be much lower.
Okay, but these slippages do not include, as I have been harping ad nauseum, those loans which are not recognized. Now, 525, let us assume let us assume only for the sake of hypothesis that it is a troubled asset. It's an impaired asset. It's a stressed asset. It is not yet a default. In that case, if you include that category, would you still say that as a ratio of total, we will come down, or we have to wait to make that statement?
Lata, I've been telling you continuously, I don't agree with you on that. We have on our books quite a few good accounts, standard accounts, where we have stretched the loan, the refinance the loan, because there's an option given to us.
Absolutely fair.
See, and you must understand, world over, this is the way projects are financed. It is only that in that country we didn't have the option, because any refinancing, RBI was called as restructuring. And you must understand, refinancing is done only of standard assets. It is not done of stressed assets. The NPA cannot be if you do a refinance of NPA, it will obviously continue to be an NPA.
Mr. Pradeep Kaur, I completely take your point that a lot of healthy companies have extended their credit lines because they are faced with some temporary downturn. I'm not denying that. But the analyst community continues to maintain that loans like Ratnagiri or like SR Steel, which are 20 years old and which have got a refinancing or will get a refinancing can be passed off as non-NPLs or non-stress loans. This is not my definition. This is the accepted industry norm. So I'm just going by what the investor community wants. There they see stress. And if you were to include that, would you say that we have to wait for a quarter before things...
Couple of things. So I would not like to comment on individual accounts, but I would like to say whenever we do a refinancing under the 5/25, we do for 80% of the remaining life of the asset.
Okay.
You must understand many of these steel plants, power plants have very long life. They are not 10 to 12 duration. They yield revenues do come in even after 25-30 years. Okay. So I think there's nothing wrong for us to extend the tenure, and I'm not talking about any specific asset.
Point taken. Okay. Well, there seems to be a disagreement on the way we have to understand all the 525 loans. Let's agree to disagree. And Shrikant, once again to start with you, we've had a bunch of announcements. The power distribution companies are likely to see their loans getting transferred to state governments, as well disentangling of environmental clearances, fuel linkages. Are you getting a sense that the policy environment is going to make for better loans and less bad loans?
I think clearly from a policy perspective, from an operating environment perspective, things have clearly been on the positive track. There may be a debate on the pace of it, but directionally we clearly think it's on the right track. Having said that, we need to set the expectations right. The crux of the problem that we are seeing both in the corporate sector as well as in the banking sector is a balance sheet problem. There is too much debt on corporate balance sheets, banks have a lot of NPLs and too little capital. Now, balance sheet problems, if you really have to resolve them quickly, the only way of doing it is by infusing a lot of capital. Absent that, by definition, the recovery will be slow because for leverage to come down, you need to get the benefit of time. So we need to keep that in context whenever we are evaluating the extent of policy effectiveness.
Okay, what your take, Mr. Pradeep Kumar? You think that credit offtake is likely to crawl higher? We cannot expect too much of greenfield, but are you seeing the first signs of urban discretionary demand returning, retail demand returning, so much so that the stock of good loans rises to smother the percentage of bad loans?
If you see the bank's growth of loans in the last 4 or 5 years, the corporate book has primarily grown due to project loans. Of course, the retail growth has been fairly good. I think this year also I find even the public sector banks' retail growth at more than 15%. Of course, some of the private sector banks have done very well beyond 20%. Retail growth continues to be, I think, very good opportunities are available. As regards demand from corporate, I would say it's still muted. Yes, maybe it is better than what it was if you had asked me this question 6 months back, but it is not something. There is a huge demand. I think the demand for credit will grow up slowly.
What is the kind of credit growth you're expecting this year for the industry?
For the industry, maybe 12 to 13% at best.
Which is still better than what you all did last year.
Yeah.
Well, thank you very much, gentlemen, for joining me in this discussion. All right, key takeaways. 1, the stock of bad loans in the system will still rise. But 2, and that's the pleasant news, as a percentage of total loans, the percentage of bad loans will go down. That's the message coming in from the rating agencies. It has peaked at 11%. But 2 major parties disagree. One, organizations like Credit Suisse, which point out that there are a bulk of stressed corporate balance sheets which are still standard in the books of banks, and therefore they see stressed loans actually rising to 17% before it starts declining. CARE Ratings also believes that the quantum of bad loans will rise for a couple of quarters more, and it will only by April that you will start seeing a decline. There is a case that quality of good loans will grow, but that growth will be slow because global demand and domestic credit growth is growing very slowly. Therefore, what you have on your hands is a U-shaped recovery, not a V-shaped recovery, but recovery nonetheless. That's it on this edition of Indianomics. Thanks for watching.